Are you ready to navigate the turbulent waters of today's economy?
Absolutely. Join financial experts like Danielle DiMartino Booth and Bill Smead as they share their critical insights.
We've leveraged AI technology to condense their deep analyses into time-saving summaries for you.
Get ready. From inflation impacts to labor market volatility, these insights have the potential to shape your investments.
Today, we're diving into an insightful analysis by Danielle DiMartino Booth on the current economic landscape and inflation trends.
Danielle discusses the challenges posed by inflation and its implications for consumer behavior.
Danielle shares her perspective on the recent inflation report, noting unexpected patterns in consumer prices.
She emphasizes that the increase in food prices, especially eggs, has significantly affected the inflation rate.
Danielle asserts that wage growth is a crucial factor driving inflation in today's economy.
She explains that as wages increase, consumer prices also rise, creating inflationary pressures.
Discussing consumer trends, Danielle points out that rising inflation is prompting many households to change how they spend.
This shift reflects growing anxiety about the financial burden of ongoing inflation.
Danielle discusses how the Federal Reserve's strategies impact economic conditions.
She notes the Fed's challenges in stabilizing inflation in a turbulent economic environment.
What does Danielle predict about inflation looking forward?
Danielle speculates that as inflationary pressures subside, stabilization in consumer prices could be forthcoming.
In conclusion, Danielle emphasizes the importance of tracking inflation trends closely.
She also highlights the need for households to be vigilant with their budgets in light of ongoing economic changes.
Welcome to Trade Brigade. Today, we dive into the labor report's impact on the market.
Absolutely. Let's discuss the critical data and its implications for trading this morning.
We're informed that the unemployment rate is believed to be around 4.1%, which is a tad higher than the previous month's 4%.
Additionally, forecasts indicate that non-farm payroll numbers might present weaker figures than expected.
Today's market reactions may reflect broader economic feelings about labor trends.
Right. It's essential for traders to be prepared for significant volatility right after the report.
Our hosts highly recommend a careful approach for today's trades, especially for establishing new positions.
It's crucial to remember, if you're in profit this week, try to maintain those gains.
If the unemployment rate reaches approximately 4.2%, this might lead to further declines in the market.
However, if trading remains contained within the day, we might stabilize as forecasts suggest.
As our hosts conclude, a patient approach and securing profits is key for today's trading.
Let's keep tracking key levels and respond as new data comes in.
Today, we'll summarize insights from Jeff Snider at Eurodollar University on the severe drop in oil prices.
Jeff highlights that WTI crude has drastically decreased, raising serious economic concerns.
Jeff Snider argues that the crash in oil prices signals a looming economic downturn.
He notes that this decline isn't merely advantageous for consumers. It highlights significant underlying economic issues.
According to Jeff, the oil price decline connects closely with diminishing consumer demand and weak employment figures.
His analysis suggests we may be witnessing early signs of recession that cannot be ignored. Jeff points out that central banks reducing their rates signals economic weakness, not growth.
This represents a significant shift in the financial outlook, as reflected in the correlation between interest rates and oil prices. What predictions does Jeff make regarding the near future in light of the oil market developments?
He warns that without evident signs of growth, we may encounter a recession, as financial markets are already pricing in these risks.
Jeff concludes that the current state of oil prices acts as a caution for investors to proceed with caution.
He urges all stakeholders, policymakers, and consumers alike to take these indicators seriously to successfully navigate the shifting economic landscape.
Today, we're looking at the potential fallout in the housing market if the Consumer Financial Protection Bureau is weakened, drawing on insights from mortgage expert Dave.
Dave outlines how removing restrictions on foreclosures could lead to a surge in market instability, as seen in past crises.
According to Dave, the CFPB plays a critical role in how many foreclosures enter the market.
He argues that if the CFPB were to relax these regulations, we could see a significant rise in foreclosures, reminiscent of the 2008 crisis. Dave emphasizes how government actions over the last 2 decades have significantly influenced property values.
Are we on the brink of experiencing another housing crisis, given the political climate?
Dave highlights that the current political landscape may exacerbate foreclosure rates as regulations become less stringent. What does Dave predict regarding upcoming regulatory adjustments?
Dave anticipates that if the CFPB is significantly weakened, more foreclosures could hit the market, creating an excess supply of homes. Dave notes the essential functions of Fannie Mae and Freddie Mac in ensuring mortgage liquidity.
Their management of prior financial crises shows the need for stable government-backed entities during market downturns. What does Dave anticipate for the foreclosure landscape in the upcoming year?
He warns we could see sharp increases in foreclosures if current protections are lifted.
Dave suggests that potential homebuyers need to stay alert to market changes driven by policy shifts.
He emphasizes the importance of understanding ongoing discussions surrounding government regulation of the mortgage market.
Today, we delve into the ramifications of the IRS's announcement of layoffs affecting approximately 45,000 of its agents, as discussed by host Mitch Beckler.
Mitch emphasizes that these cuts raise serious concerns for many Americans awaiting their tax refunds.
Mitch Beckler suggests that America is facing serious economic challenges that jeopardize job security for many.
He notes that individuals are beginning to realize the gravity of the economic situation.
Mitch argues that it's crucial for individuals to take charge of their career advancement, rather than solely relying on their employers.
This proactive approach is essential in today's uncertain job market.
Mitch highlights the increasing challenges in Florida's housing market due to a rise in inventory and ongoing affordability issues.
He stresses that first-time homebuyers need to be well prepared as competition continues to grow.
Mitch predicts that job seekers will continue to face uncertainty as companies struggle to maintain stable employment.
Similarly, homebuyers in Florida may find the housing market remains difficult.
Mitch emphasizes that proactive financial management is crucial for individuals facing economic challenges.
He encourages viewers to educate themselves about the home buying process to navigate the real estate market effectively.
Today, we unravel the current precarious state of the S&P 500, featuring insights from Bill Smead.
Bill, what are your thoughts on the recent tariff announcements and their impact on market sentiment?
Bill Smead insists that the S&P 500 faces increased challenges due to the latest tariffs imposed by the U.S.
He warns that these factors could lead to significant downturns reminiscent of past bear markets.
Bill recalls how prior bear markets often followed tariff hikes, suggesting history may repeat itself.
He cautions investors to take heed of current market conditions reflecting similar prior declines.
Amid rising bearish sentiment, Bill proposes that this environment could indeed create opportunities for value buying.
He urges investors to reevaluate their strategies, prioritizing value amidst this uncertainty.
What are Bill Smead's predictions for the S&P 500 in light of these economic challenges?
Bill believes current conditions could pave the way for market downturns, advising caution for investors.
In conclusion, Bill emphasizes that investors should focus on diversifying their portfolios with an emphasis on value stocks.
He reiterates the importance of staying alert to economic signals as we move forward.
What an incredible array of insights we've gathered today.
Absolutely. From Bill Smead's warnings about tariffs to Danielle DiMartino Booth's cautious optimism about inflation.
It's fascinating how many experts agree that regulatory vigilance is crucial for market stability.
Right. Yet there's so much divergence, especially regarding inflation's future and the IRS layoffs' impact.
Indeed, Beckler sees immediate challenges while Smead warns of long-term consequences for the S&P 500.
Exactly. And with Snider highlighting potential recession signals due to oil price drops, the conversation remains as urgent as ever.
If you found value in these discussions, don't forget to like, subscribe, and share this video.
Your support keeps the insights coming from top financial minds.
Stay tuned for our next episode, where we dive deeper into global economic trends. You won't want to miss it.